Municipal bonds are safe. Ooh, this is part 6, and this will be the last part we do of the 8 great misconceptions of bonds that Alan Roth had done on Advisor Perspectives. The other 2 kind of bore me, so I'm not going to do those. But I do want to do this one. Municipal bonds are safe because we're going to show you how safe they are not. You talked about that, and then separately. Okay, good. So let's talk about this. Many think that munis have little risk, and that muni bond defaults were only about, 1/2 of 1% during the Great Depression. I'm not against owning a low-cost municipal bond fund, but only in moderation. States and municipalities have $4.5 trillion of unfunded pension and healthcare liabilities. That in spite of a surging stock market. If stocks don't do very well over the next decade, the shortfall will mushroom as baby boomers have retired. As monthly benefits continue, there will be systemic risk to municipals. This presents a significantly different situation than what happened during the Depression or Meredith Whitney. Remember that? She said in 2010, her famously wrong call on 60 Minutes that calling for hundreds of billions of dollars in defaults the coming year. I'm worried about a long period of time and only if stocks don't perform well. So I want to show you guys something because I agree with that 100%. The Illinois pension bomb has a short fuse. A crisis exposed weaknesses. The COVID-19 economic crisis shows the danger of government making promises it can't afford. Here in Illinois, the crisis has served as a dress rehearsal for the kind of havoc the state's pension crisis could inflict on the economy and government retirees if nothing changes. More than 1 in 10 Illinoisans, or 11.4% of the adult population, are members of an Illinois public pension system. That's flipping nuts. These government retirement systems are sitting on mountains of debt. There are $144 billion in debt in just the 5 statewide systems. By the state's conservative estimates, or $261 billion in a more realistic independent estimate. They average only 40% of the funds they need to pay out retirees' long-term benefits. So let's just make sure the date on this is April 21st from the Real Clear Policies. That amounts, if you add in local pension debt, Illinois unfunded pension liabilities total more than $200 billion by the state's measure, and that grows every year. Another shock such as the Great Recession could cause the first pension fund to run out of money by 2039. When I say run out of money, I'm not sure if that's not, because Social Security doesn't run out of money. Social Security just will have enough to pay 100% of its promised benefits, but it's not running out of money. That amounts to a broken promise not only to retirees who are banking on having their pensions, but also to taxpayers who continue to get hit with higher taxes just to keep them from tanking. Illinois politicians have enhanced benefits without funding them and pushed off the financial reckoning for decades. As a result, pension fund costs, which took up just 4% of the state's budget in 1990, increased by more than 500% during the past 20 years, and now is approaching 30% of the state's budget on pensions alone. What's more, generous retirement perks have been promised time and again, then cannot be delivered without financial hardship to the rest of the state. With employee contributions and benefits both fixed by state law, shortfalls in investment returns must be made up by the taxpayer. Illinois Career Public, I can't see with that. Illinois career public employees pay little for excessive retirement benefits. I can't really see that. So the cost of public pensions has grown so fast that taxes have gone up year after year, and even that isn't enough to stop the mushrooming liability. As a result of overly optimistic expectations for growth, taxpayer contribution would have to grow much faster than the official projections suggested they would. It's bad enough now. But without transformative changes to pensions, a severe economic downturn will start the slide in the economy. Yep, 100%. All right. So the point being is a lot of these will fund these municipal bonds in order to fund their pension. It's literally no different than refinancing a credit card is what they're doing. They're saying, hey, we're going to borrow from this credit. I'm not refinancing. Borrow from this credit card with a convenience check to pay off that credit card. And how they do that? Well, they issue bonds. And they say, we'll pay you higher than market rate of interest because we know you got to get rewarded to buy those bonds because of the risk that you're taking. And I tell you, man, you'd be a fool to buy those bonds because at the end of the day, the union always comes over Wall Street. So they're going to say, well, the bondholders are Wall Street bankers. They should pay. And somewhat they're right. And so the union, the taxpayers, i.e. the voters, will always have a more say over the people who hold the bonds. Now, if you're Granny Smith down the street in Paducah, I guess that's Kentucky, in Peoria, you're getting screwed too if you own those bonds, because they're going to say, yeah, sorry, Granny Smith, you're only going to get 80 cents on the dollar. The hedge fund manager and stuff will get 40 cents on that. Well, look, we saw this with GM, dude. It's going to be the same thing here. I mean, there's no inevitable. I mean, and then when the markets go off, it's going to be nuts. And the markets go down, let's just say higher interest rates, which I'm not expecting, but just say there's no money for this. So the idea that municipal bonds are safe, think twice about that. Now, the idea that they're going to all go bankrupt, that's silly too. I remember when I was at USA, this is a long time ago, 10 years ago, and I remember talking with the bond managers. USA's got some of the sharpest minds in the bond business because they're a large behemoth of an insurance company, and they've got to manage risk more than anything on bonds. It's just the biggest holder of bonds are generally insurance companies and pensions. I remember talking with the PMs, the portfolio managers, and they didn't like New York revenue bonds, but they did like New York hospital bonds. I remember that, and I said, why? I can't remember why, but it's very interesting. This is back in 2010. Yeah, it was 10 years ago. I remember that. Man, time flies. 2010, because that was when Meredith Whitney. I said, what do you think about New York? Because we didn't like the Tappan Zee Bridge revenue bond, or maybe they did like that. But I remember they liked the New York hospital bonds. I can't remember why, but it's interesting. But they didn't like the Tappan Zee Bridge, the revenue bonds that they had. They were both municipal bonds, because my client base was in New York City primarily, and so a lot of people were looking for the tax-free status, a triple tax-free, New York City, New York State, and the feds. But anyways, I don't know how that's shaking out, but it's just interesting because the municipal bond market is ginormous, my friends. And you just got to be careful there, because you're investing, think they're safe. Eesh, I got a bridge. Didn't they change the name of the Tappan Zee Bridge? Or they got rid of it or something? I don't think they got rid of it, but they changed the name. Or did they get rid of it? Anyway, well, I'd like to hear your comments. We'll see ya.